Yeah.
All right, we got another question here from Italy. I didn't realize we were so important of a listen in Italy, but
Huh. Yeah. Look at that. This is a great one. I'll read this one. What if 2025 will start with the worst crash of all time? How do you think people will react? So I don't know when this was sent in. I didn't check the date, but it was clearly before 2025. It's kind of fun having these questions that were sent in a long time ago. It's like this time capsule into what people were worried about back then. And then we get to discuss now with the benefit of hindsight, knowing exactly what happened. 2025 did start with quite a crash for US stocks, nothing historically unprecedented, but lots of volatility. I looked at the numbers from January 30th through April 8th, 2025. XUU, which is the iShares Core S&P US Total Market Index ETF, dropped by 19.7%. That is measured in Canadian dollars, to be clear. It's a Canadian listed ETF. Now, some people were very concerned. Like you and I, Dan, co-authored an email that we sent out to all of PWL's clients because everyone was very concerned at the
mhm.
time, worried about what was going to happen and what all the volatility meant. Some people were not worried, but in any case, here we are now with U.S. stocks down 2.54% as of June 6th when I last checked. Again in Canadian dollars. VEQT, the Vanguard All Equity Portfolio, is up 3.6% over the same period. I'll throw in a shout out to DFA 607, which is up 4.31% year to date. That's the DFA Global Equity Portfolio. So not catastrophic by any means. Now it would be incredible, and I think we tried to kind of nudge toward this in the email that we wrote to clients. Dan, it would be incredible if we could approach all future crashes this way, only observing them in hindsight, knowing
Mhm.
that things will work out. But I think the fact that we can't do that is exactly why they're hard for people to deal with. It's like super easy to look at the numbers now, 19.7%. Oh, that's not so bad, and not feel like what it felt to live through that period when you're battered with tariff related headlines and predictions about their effects and how everything's going to collapse. I I remember how it felt then, but it's really hard to put myself back into that mindset that I had when things were really uncertain. Like it's easy to look back now and say, well, that wasn't so bad when you look at the numbers, but that really doesn't go through actually going through it justice.
Yeah, I mean, and I think we touched on it in the client letter too, right? It's not just what has happened in the last few days or weeks. It's the narrative that we're hearing and that we're telling ourselves about how much worse this could get, right?
Yeah.
Nobody who experiences a 10% decline is all that upset over the 10% decline. They're upset because they think that 10% might become 40%.
Mm,
And it's very easy to come up with scary worst case scenarios when you're in the middle of an event, whether it's, COVID or, the trade war. Both of those were very scary when you were in the middle of it. And then looking back, it turned out not to be that big of a deal. COVID is even a more dramatic example than this recent one, because at the depths of it, we were down 30% in couple of weeks, something. It was
yeah.
it was very, very deep and very fast. And then it recovered just as quickly, but you didn't know that at the time. Not only was the market down, everybody was worried about their own health. And to just look back at that now and dismiss it as saying, oh, it wasn't a big deal, or sure, we knew the markets were recovered, I think that's being a bit disingenuous.
Yep. I remember going through COVID. It was 30% doesn't do that justice what
Yeah,
it felt
it
like going
felt
through it.
worse than that, didn't it?
Yeah. Yeah, that was a rough one. No, I think this crash in 2025 was fundamentally like any other crash. Market crashes happen because of uncertainty and fear. Like exactly what you're just saying, Dan, because people don't know how much worse things will get, which makes it really scary to go through it. They don't know when it's going to turn around. Now, people are going to respond to those events in different ways, and I think they should plan accordingly. And that planning can be done through some combination of appropriate asset allocation, automation, and maybe just not looking at it, and if needed, professional financial advice. There are a couple unpublished papers. One from Steve Utkiss from Vanguard, where they looked at the effects of good quality advisors, and they had a way to measure that um, when markets were rough, and they found clients of the good advisors were much less likely to leave the robo-advisor service after bad markets, which is an interesting data point. And then there's another one. Oh, I'm forgetting the paper. It was a Canadian sample, and they looked at a similar thing. They looked at clients who had been with an advisor for a while. I don't remember what the time period was, but a longer relationship, which were much less likely to get out of the market or make their portfolio more conservative after the great financial crisis. So it does seem to be some evidence that can help.
But to answer the listener's question directly, how do you think people will react to the worst crash of all time? They will overreact, panic, act like it's the first time the market has ever gone down. And then when it's over, we'll look back and say it was no big deal because we all knew it was going to recover. So I don't think things change very much in that respect.
It's been going on for a while. There's like hundreds of years at this point of documented financial crashes and recoveries. That doesn't mean that that's always going to happen, but it's been happening for a while. And it's a pretty consistent pattern.
All right. Should we move on to the next one?
Yeah, let's do it.
This one is from Shiva, the god of death. So, okay. Ben, I think this is a question we all need to take seriously given its source. All right. Can you do an episode or a video about commissions and incentives in the financial industry, specifically calling out all of the investment advisors at banks who roll A-class structured notes for 3% a pop and do not manage portfolios? No love for the banks from the god of death.
No, doesn't appear so. It is a very common thing. Structured notes are such a seemingly attractive thing to sell to an investor with little knowledge about expected returns and risk and how markets work. And they do pay high commissions, which is doesn't help the situation. But this is a pretty well-known problem. Banks sell financial products, and they've got a very strong profit motivation. They don't really sell financial advice. Like, they kind of give advice about products maybe, but more in the way that someone, like when I go to the Subaru dealership to get a new car, they do give me advice about buying cars, but they're telling me which Subaru to buy. So it's a different kind of advice than I think what we would tend to give to a client. Just a different set of incentives. There was a March 2024 investigation that CBC did, and they found that bank employees give questionable advice, like telling people to invest in mutual funds or GICs instead of paying off credit card debt, which is like, that's about as objectively wrong advice as you can get. Misrepresenting the importance of high mutual fund fees to long-term investment outcomes and upselling customers on higher fee credit cards and lines of credit. Now, bank employees don't seem to be malicious based on the CBC report. Many of them are stressed out by the pressure to sell at all costs. There's some pretty, I don't know what I'd call it, sad quotes and interviews from anonymous employees who are having a really hard time with the sales pressure, but also with having to push products on people that they maybe didn't need. Based on some of the answers given by bank advisors on mutual fund fees and expected returns, I suspect that beyond conflicts of interest, there's a lack of education that's contributing to the quality of advice. And I think those two things can kind of go hand in hand. If you don't know what's right, it's kind of hard to give people the right advice. And it's probably also hard to deal with a conflict of interest if you're being incentivized to do one thing and you don't realize that thing is wrong. It's probably a lot harder to overcome the incentive.
I find it interesting going through the whole, education procedure, the certification process for, the financial advisory designations, whether it's even less so certified financial planner, but certainly the investment related ones. A lot of the courses and education you take are surprisingly sales oriented, right? They start from, a premise that your job as an advisor is to produce market beating returns, for one thing. And they constantly talk about products in a way that it's just about disclosure, right? As long as the client as long as you tell them about the risks, you can pretty much sell them whatever they want. Cost isn't important because after fee returns are what really, is important. So I think you're right about that. These are not bad people. These are people that are brought up in a bad system and given the wrong incentives. So it just helps. I think just as a consumer, you just have to be aware of that and go in with your skepticism up. Let's put it that way.
On January 1st, 2026, the CIRO, the Canadian Investment Regulatory Organization, will implement new rules to establish an assessment-centric proficiency model with some mandatory education and training requirements. The purpose of this guidance is to assist dealer members, existing approved persons, and individuals seeking approval prepare for the new rules in advance of the implementation date. Anyway, so they're giving guidance on what the new rules are going to look like. They give commentary on, I don't know if they give commentary on what the exams are going to be like, but it's going to be good. They're very positive changes coming to proficiency in Canada, which I think is good news.
It's definitely getting better. There's no question about that. I've noticed it just, in my own kind of education here that we're all required to do just over the last decade or so. It's for sure getting better. There's much more of a focus on planning versus investing as well, which we've seen in the industry and therefore in the educational components of the industry as well. So that's all good news. It's definitely not as bad as it was. There are much better low-cost products, and there's just, I think, a little bit more transparency than there was in the past, and higher levels of investor education. I've definitely seen that. I'd say 15 years ago, the level of awareness of fees and things was much, much lower than it is today. So we're definitely making progress.
Yeah, but you're right. Like if you go through the current reading requirements to become a licensed financial advisor in Canada, you wouldn't necessarily come away from that. If you studied that as your investment knowledge and came away and said, all right, I'm ready to invest, like you'd come away doing a bit of technical analysis, maybe probably picking some stocks, probably timing the market. Like
I think that's what I'm going to look at that as a kind of benchmark for progress is like, they've got to get rid, and to be honest, I haven't looked at it for a while, but they need to get rid of that technical analysis component to basic financial advisor training. It just jumps out as something that's so transparently without value. And that is considered not a fringe special skill that an advisor might pursue later, but what you need at the very basic level to advise your clients. It's just nonsense.
Yeah. Anyway, I think even the harmonization or the merger of the MFDA and CIRO, I think that was also a positive development. Like getting a mutual funds only license was even more. The education requirements, the bar was lower. I'm trying to be gratuitous here. The bar was lower to get a mutual funds license, which is you could still sell investment products to people. Anyway, all that to say, I think part of the problem with the listener's question here stems from a lack of education for people who are licensed to sell, are able to get a license to sell financial products. And there is evidence supporting that. Like there's a paper in the Journal of Finance that's a pretty well known paper. Ioanni Linema was a guest in this podcast. He's a co-author of the paper. Actually, Stephen Forrester as well. Two co-authors there. I think have been guests, which is kind of neat. So they look at a Canadian sample of financial advisors and the advisors' clients, and they find that advisors typically make the same mistakes personally as they do in their client accounts. They're trying to ask, like, is bad financial advice coming from conflicts of interest or is it coming from education? And so they find that advisors trade too much, chase returns, prefer expensive actively managed funds, and under-diversify, both in their clients' accounts and their personal accounts. Their personal accounts underperform just as poorly as their clients' accounts do. And one interesting thing they do is they show that advisors don't strategically hold these expensive, they don't make these mistakes on purpose to convince their clients to do the same. Like, hey, look, I'm doing this too. But the advisors continue to make the same mistakes after they leave the financial services industry. So when they no longer have that incentive to say, look, I'm doing the same thing as I'm telling you to do, they continue making the same mistakes. So that paper suggests that conflicts of interest are only part of the problem, and it does highlight the importance of education for financial professionals and for consumers to seek out financial advice from people with appropriate credentials and training. There is also a 2018 paper in the Review of Financial Studies that's very relevant to this listener's question. They used data from a large retail bank to analyze how banks and their financial advisors generate profits from customers. And they find that advised transactions earn the bank higher profits than independently executed trades placed by the client. And unsurprisingly, the bank's own mutual funds and structured products are the most profitable products for the bank. That is not surprising. And bank profits increase with trade size. And further unsurprisingly, bank advisors recommend those transactions, large transactions into the bank's own products. Now, if those transactions were making clients better off, we might say, well, hey, these advisors are just giving good advice. But the research finds that advised clients have worse performance than unadvised clients. So this research really suggests strongly that advisors are putting their employer's interest first. I mean, likely due to incentives, but that is the system that the bank creates because the bank exists to generate profits and sell products in order to generate profits.
Yeah, and I think it's worth mentioning too, a reference to the listener's specific question about structured notes, right? So these are products that are extremely common in the bank advice channel. I don't even think anybody offers them other than banks. At least you don't see them nearly as often in other advice channels. But, for listeners who might not be familiar with them, typically they are products that are sold to you with a return that is tied to some underlying index or some underlying investments. And just to give you an example, I had a client just very recently ask me, he had a friend of his had said that there was a product that he purchased from a bank that was tied to the big 6 Canadian bank stocks, and it yielded 9%. Okay, so, if you hold this biggest 6 bank stocks, your yield is, I don't know, a little under 4% probably today. So where is this 9% coming from? Well, I don't know. The investor doesn't know. The bank knows. There's something built into the structure of that note. I don't know whether it's returning some of your original investment to you, or there are hidden risks and hidden structures that are extremely difficult to understand. And when those are packaged into an investment that sounds extremely enticing, like a 9% yield, this is a recipe for people buying products that sound superficially inviting, but they have no idea how they work. And so if these are sold to you by advisors, and I've said this to people before because they've told me they've been offered them, I said, you ask your advisor to, in plain English, describe to you where that return is coming from. And if he starts hemming and hawing, or she starts, feeding you a whole bunch of BS, right off the bat that there's risks that you're not seeing. And these products I just think are extremely dangerous because they're that toxic mix of extremely attractive at a surface level and extremely complex once you start digging into it. They're huge money makers for the banks. So, it's one thing to talk about high price mutual funds. I think these are actually a lot worse.
Well, yeah. So they're profitable for the banks because what the bank will do is they'll structure this payoff stream. So in the 9% yield case, like I'd have to look at that specific product, but typically what that number will be based on is the total returns. Like that'll be the headline yield, the headline return, which is like basically the best case return you're going to get from that product. And so if the bank stocks increase in value up to some point, then you get to keep this high yield. They might cap your downside, but they structure these payoffs using options. And what the bank will do is they'll structure the payoff that costs them some amount to hedge. So they know exactly how much it's going to cost them to buy the products, the underlying financial products that's going to allow them to deliver the payoff to the customer. And then they're going to sell those payoffs to the customer for a significant markup. So they're very, very profitable for the bank. We did an episode episode 261. We had two researchers, Felix Fattinger and Petra Vokata, who have each great research on structured products specifically and just how they're sold, how they're packaged, how expensive they are, how big the markups are. So that's one of our longest episodes ever because we did two pretty in-depth discussions with like two individual conversations we put in one episode. We went very deep on structured products. And actually, Dan, I think there are people in our like portfolio manager channel who are using structured products too. They're going to be different. Like they'll be F class products, not paying commissions like the one somebody at the bank is selling. But I've had some Twitter spats when I was more active on Twitter with people who are PMs who are promoting this type of thing, using the same kind of I don't know what I call them, appealing to the same types of biases that make these things attractive to retail investors.
Yeah, there's
Yeah,
always a better product to deliver something similar. Let's put it that way, right? It may not be as enticing in the marketing materials, but if you want to get most of the upside but less of the downside, like there are always better ways to do it than structured notes.
yeah, and that's exactly what the research on this suggests, that whatever it is that you're trying to accomplish, there's a better way to do it
That's
than a
right.
structured note.
Yeah.
Unless you want that exact, very specific
Mhm.
payoff, they will give you that, but you're going to pay a markup for it, which I don't know. I've talked to one advisor who kind of thinks like we do, like they mostly use index funds. They think markets work, but they will use structured notes in certain cases. Like in the case I'm thinking of, if the market drops by some amount, say it's like a 20% threshold, they will go to a bank with their pricing of a structured note. Like, this is how much this should cost. We're not going to pay more. And they'll negotiate a large allocation of that. And then the bank will structure it. And it'll be something like when the market drops 20%, we're going to buy the structured note that gives us leveraged upside with limited downside. And they just kind of systematically do that. Yeah. My reaction is the
Yeah.
same as yours, Dan,
My
but
eyes are
that
rolling for those who are listening here.
that is a less crazy use of those products, and they're very specifically pricing them out themselves and going to the bank and saying this is what this is worth. We'll allow you to do this much markup. So that's the least crazy use of those products that I've ever seen, but it's still to me crazy.
It's the least crazy, but there's still some crazy elements.
It's a spectrum of crazy. It doesn't come off that spectrum with those products.